Hi, I'm Michael Rudnicki, a partner in the Bowman's tax practice responsible for private equity. I'm joined by Mark Linington, Samir Ellary, and Phuti Kgomo. Media reports suggest that the global 2024 private equity outlook will center on exits and dry powder. Activity levels, though, will be challenging given high interest rates, the unstable global outlook, and cautious investment sentiment. Tax features, unfortunately, are not mutually exclusive. So we thought it beneficial to bring senior members of our private equity tax team around the table to talk about key tax touchpoints impacting exits and pressure from LPs to return capital and investable dry powder. This session will focus on exits. Mark, in terms of exits, what are some of the structuring considerations you've seen recently in the market?
We've seen some challenges where private equity funds can make more money by selling individual businesses within a portfolio company or portfolio group of companies instead of selling it all lock, stock, and barrel. So as you know, most funds want to sell the shares and loans in a top company or the top company in a group of companies. This is because most or many of their LPs are foreign or they're exempt from normal tax in South Africa. So by selling below the top company or a group of companies, corporate tax and dividends tax is incurred, which is a tax which falls indirectly on the LPs. So it hurts the returns of the fund. The businesses are normally separated by moving them into their own newcos, and then for the top company to unbundle these newcos to the fund so that the fund can sell. However, a lot of tax can be incurred in the process, which could be minimized by careful planning, like unbundling the least valuable businesses and utilizing the right rollover concessions to optimize the base costs in the group. One also has to take into account any degrouping clawbacks if this all happens within 6 years of the acquisition. But the golden rule here is to do this as soon as possible after the acquisition, before there's value uptick from the acquisition price. Don't wait until you're looking at an exit to split up the portfolio company. It could be expensive from a tax perspective. Another common topic we see is share buybacks. Share buyback allows South African companies to realize their shares in other companies without incurring corporate tax. That sounds great. Obviously, National Treasury don't like this, so they introduced rules to recharacterize 85% of the share buyback as a share sale. These rules, however, only kick in if a company has a controlling interest in another company, or if there is no controlling shareholder at a percentage level of 20%. So it's still possible to do share buybacks. But the question is a company safe from a SARS attack if they hold less than 20% in another company and the shares are bought back? We like to think that SARS and National Treasury have defined their pain threshold around this issue, so they're not going to look to challenge buybacks under 20%, but it's not without risk that they do. So you have to be quite careful how you structure the buyback. Don't change tech through the deal negotiation process. Have it all preconceived in your offering memorandum, etc. So you have to be quite careful if you're going to do share buybacks. Thank you.
Thanks, Mark. Samir, one of the often misunderstood and ignored exit themes is the impact of exchange control for sellers. What are you currently seeing in terms of trends?
Yeah, thanks, Michael. I suppose more generally from an exchange control perspective, we certainly have seen a slight improvement in the SARB's response. There was a period in which they underwent a sort of restructuring, particularly in their investigations unit, and that had an impact on applicants where people were receiving sort of holding emails and seeing long turnarounds on applications, particularly regularization applications. So that we are seeing a slight improvement in that. Still awaiting certainty or clarity on the structures, which are obviously quite a key point for in the private equity space. But in the context of exits, we are still seeing a lot of transactions and exit transactions in particular where historic non-compliance still features. Good examples is just partnership interest not having been disclosed or approved. Share certificates, again, not having been endorsed originally. It worked on a recent transaction where, throughout the transaction, we were told we've got original share certificates only to find out that we had endorsed copies. And of course, all of these things ends up delaying transactions and delaying closings and delaying your exits. Another key feature, I suppose, in exit transactions is your valuation certificate. So there again, often, in a transaction, there might be internal valuations prepared. But of course, for exchange control purposes, particularly in a cross-border transaction, where one needs to prove fair market value having been received by the resident or the resident, for that matter, paying nothing more than fair market value, one does need an independent valuation certificate confirming that that transaction is taking place at an arm's length price. So there again, I think these are just areas in which, it's still a good idea for parties to get their house in order ahead of any exit transaction. And if that theme, or if the theme or trend for this particular year is exits, that is a recommendation we would certainly pass on to clients and within the private equity space is get everything in order and avoid delays on those exit transactions.
Thanks, Samir. Phuti, management is key to IRR longevity for LPs. What are some of the lookout points where lock-in restrictions, in particular, are imposed on management shares in portfolio companies?
Thanks, Michael. I agree that management is quite essential to the success of any business and enabling an investor to meet or exceed its expected returns. Often the management that's participating is founders of a business, and investors would like to retain them as co-investors, either through the entire investment period or for a sufficient amount of time to allow for succession planning. There are a number of ways in which management can co-participate with an investor, and these can be implemented either individually or a combination of these alternatives. This could be management acquiring shares, growth shares, which allow management to participate in the growth of the investment. And what we're seeing in the market now is the use of exit bonuses. Whilst I've referred to founders being part of management, these management can also include senior managers or other key employees who have been in the business for a long time. For an investor, the key is really to implement an appropriate structure that will incentivize management and enhance the IRR. As co-investors, management will then fulfill dual roles, employees on the one hand and shareholders on the other. Regulating these dual roles is often where restrictions can come into play, where an investor may seek to include terms such as good leaver, bad leaver, lock-in periods, or drag along terms which have an impact on management's ability to dispose of their shares freely. If these provisions are not structured correctly, Section 8C of the income tax could come into play. The effect of this section is essentially that management will be subject to tax at their marginal tax rate, typically of 45%, or as opposed to the effective CGT rate of 18%. Now, this is a more than double tax cost to management. To try and curb this happening right at exit, we would recommend what we term pre-exit diagnostic, where the incentive schemes in place and the terms thereto are reviewed prior to exit to ensure that management and the investors are on the same page as to what to expect upon exit, and or try to amend the terms to the extent possible to minimize the impact upon exit. Thanks, Michael.
Thanks, Phuti. Well, we hope you enjoyed that discussion and found it of interest to you. We'll see you soon, where we will discuss tax features impacting investable dry powder.